Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning. This is Quincy Krosby. It's Monday morning, September 12th, and this is The Talking Point. Thank you so much for joining me. This is another very important week for the market. The Fed, by the way, if you don't hear from them, it's because it is the blackout week before the Federal Reserve meeting. Remember, next week, September 21st, is the day that we will get the Fed's opinion on inflation and the rate hike. What is it going to be? And by the way, right now the market is expecting a 75 basis point rate hike, not 50 basis point, but 75. In essence, Chairman Powell was kind of telling us or telegraphing that to us, but the fact of the matter is we still won't know for sure until we actually have the meeting. But I do want to say that the Fed funds futures market right now is actually pointing to a 75 basis point rate hike on the 21st. Now, one thing I do want to go over here is this week, because it is about inflation. Even today on Monday, at 11 o'clock Eastern, we will hear from the New York Fed, and they will have their 3-year inflation expectations report. Important. The main reason is we do not want to see it climb higher, right? This is key. We don't want to see it climb higher. And then, also very important, is on Friday. This is the University of Michigan Consumer Sentiment Index. But in that report, we will also have a 5-year consumer inflation expectations report. And what do we want to see? We want to see it coming down. We do not want to see it climbing higher. The reason for this is when consumer inflation expectations keep climbing higher, as they did, right, as they did when gasoline prices were going up nearly every single day. The problem becomes that there's a psychology embedded in this, and that we, the consumers, start thinking along the lines of, you know what, you better buy it today because tomorrow it's going to be more expensive. And it just keeps going that way. And, what happens is prices do keep rising because everyone knows that the consumers are thinking along those lines. And, we either go along with it and keep buying or we hold back. The Fed wants to break that psychology. And by the way, it's been successful as gasoline prices have been coming down. We have seen consumer expectations coming down, and that is good news. The Fed does not want to see it entrenched climbing higher. Now, by the way, I do want to report this, that you don't want the opposite either. You don't want that, the consumers start seeing prices coming down, 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 because that is deflationary. And what is the thinking then? It's, by the way, don't buy it today. Wait, because the prices are going to come down. And it doesn't matter, what it is we're talking about. It could be food. It could be furniture. It could be ticket prices. It could be automobile prices. But how about this? Condo prices. If you start thinking that we are going to go into a deep recession and that prices are going to come down, that deflationary mindset hits. And that's what happened, by the way, in 2008, 2009, in terms of houses, in terms of condos, until that was broken by people coming in and saying, boy, these prices are so low, let's start buying. So I just wanted to point that out. It's two sides of a coin. Inflationary higher expectations and lower expectations. So this week, it is going to be an important week to give us a sense of where prices are going. And we are going to get, obviously, the Consumer Price Index coming out tomorrow, September 13th. The expectations are that it will come down. The headline will come down, and the reason is that gasoline prices have been coming down. This is for the headline report on consumer prices. And then, of course, you have the core. This is all for the month of August. Expectations are that they will stay the same. The reason is it has to do with rents. Rents represent in the core of the CPI report, Consumer Price Index report, 30%. Now, we are seeing, in fact, prices across the country starting to level off, but in pockets of the country, rents coming down more than expectations. I don't know if it's going to hit for the August report, but perhaps when we get the September report in early October, we'll start to see that core come down also because rents are starting to come down. The other thing that we are going to see tomorrow is the National Federation of Independent Business Index, the Small Business Index. This is one of my favorite indices, and the reason is small businesses are the backbone of our country. And one of the things that they focus on above all else is how are sales going to be affected by higher prices, higher taxes, and so on. And so we get a really good read from the Small Business Owner Report, and that comes out tomorrow morning, Tuesday morning. Again, it's one of the ones that I pay very close attention to, and I think that Washington does too, because small business owners vote. They care about, again, their businesses. Higher taxes affect them. Everything affects them, especially how it's going to affect their sales. So we'll pay attention to that. And then on Wednesday, we will get the Producer Price Index. And again, this is for August. And the reason this is important is that the Producer Price Index takes into account all of the input costs of actually putting together a product. So we're going to see where that comes out. Now, wages, that's something else because wages are a major input cost for companies, small business owners, for larger corporations. And one of the things that we're looking for is hoping that wages are leveling off. There are reports that wages are, in fact, leveling off. I want to mention here the Beige Book that came out last week. Now, a lot of people say, oh, it's not important, Quincy. It's so old-fashioned. But you know what? It actually gives us a read on the various areas within the country where the Federal Reserve System goes out and talks to small business owners, large corporations, and banks. And what did it say? By the way, I think anecdotally it's important because it happens to be, I think, a fresher look at what's going on in the country. But something stood out to me when that report came out last week, the Beige Book. And that is, the report was that 9 out of the 12 regions for the Federal Reserve Bank system said that prices were coming down. And also an overall report saying that many of the respondents, those whom they talked to, said they believed that wages were starting to level off across the country. I thought that was good news. And I thought it also helped the market when the report came out last week. This week also, we're going to have retail sales, obviously extremely important because the consumer is 70% of the economy, and we're still holding on. We're still spending, perhaps slower, but we're still spending. And what the Fed wants is for us to control our spending so that we force prices to come down. And we'll see. You don't want the consumer to, completely collapse because that would not be a good thing because we're so important in the overall economy. 70% of our economy, to repeat, comes from consumer spending. We're also going to have this week on Thursday the Philadelphia Fed Manufacturing Index and also the Empire. These are important reports, but particularly the Philadelphia Fed Manufacturing Report. The point is, are we seeing new orders coming in? Are we seeing a, slowdown in hiring? Very important. And last report, the Empire Fed Survey had a different report, in essence, in terms of the trajectory than the Philadelphia Fed. So I watch the Philadelphia Fed report. It has a closer correlation with the America's, manufacturing hubs in the Midwest. And I think the Philadelphia Fed is most closely watched by the market. And we'll also have industrial production. And then on Friday, we'll have the University of Michigan Consumer Sentiment Index. And again, to repeat, it also includes the consumer inflation expectations. Very important for the Fed. Now, overall, I want to mention that today we are going to have an auction for the 10-year Treasury bond. Important because we want to know where it lands. What is the price? What is the final price for it, and who's buying? This will be important because one of the other things that helped the market last week was that the 10-year yield Treasury yield came down. It didn't climb higher. It pulled back, and that was good news for the market. Along with, by the way, the sense that the U.S. dollar weakened. And we also come into the market this week with the 10-year Treasury yield down a bit. We also have the U.S. dollar, especially vis-a-vis the euro, down a bit today. Good news for the market. But obviously, everything is focused on the data releases coming out today. And then what's going to happen is by the end of the week, there will be probably a kind of recalibration of what the market thinks the Fed is going to do on the 21st. It will be based on the producer price index and, of course, the consumer price index. But the Fed, I think, made it very clear that they were going to move higher. And this is another thing before I end this call. It is if the market has expected the Fed to go with the 75 basis points on the 21st, but then start to ease, not pivot, by the way, not pivot and stop and say, oh, we're finished. No, but ease and maybe go towards 50 and then 25 basis points towards the end of the year and then hold. Because remember, the Fed has been adamant, Powell has been adamant that we are not going to start cutting rates right away. We're going to hold to make sure that we bring back price stability. And that's important, that holding notion, because, again, the Fed and the market had believed that the Fed was going to start cutting rates right away because the economy was going to tank and they would start, cutting rates in early 2023. The Fed has made it clear that they want to hold on, make sure that inflation is finished before they, look at what they're going to do next. So this is an important shift in the market that, okay, they give us 75 basis points, then they maybe go to 50, maybe they go to 25. It's a recognition that the Fed finally acknowledges that it takes a long time, 7 to 8 months, before these rate hikes work their way into the economy. It's a major lag effect in the way the rate hikes and rate cuts, by the way, work. So I think the market is looking at maybe the end of the rate hikes at the end of this year. The Fed goes easier and then holds. And that maybe, just maybe, the economy can hold on. A lot will come out from this week. Is the consumer continuing to spend, albeit more slowly? I end this call with the following. We have people in this country that still have an awful lot of money. And how did I, come upon this great thought? Well, it came about, not exactly profound, but I looked at a report that said Americans are still buying luxury vehicles, very, very expensive luxury vehicles. Now, how does that happen? It's because there are people who still have the ability to continue to spend. The Fed has made it very clear that lower wage earners are hurt by the higher prices. They're hurt by higher credit card payment now, and they're hurt by overall inflation. And the Fed has talked about this. And the lower wage earner, the necessities are costing them more. The middle class, you saw from the dollar store stores coming out and saying, hey, we have new buyers coming into the stores, those with over $100,000 in household income. Well, guess what? Walmart said this a couple of weeks ago. They're seeing more and more folks coming in with household incomes of $100,000 or more. People are going to lower brands. In other words, coming down from the flashier brands that we know and going down into the what we call the store brands. So this is a shift. This is a shift. Folks, the average American, but there are people who are not average Americans. They have a lot more money, and they're buying very fancy cars. Oh, my goodness. So what we want is that consumer spending holds up, but because we know the Fed is watching this, at a slower pace so that prices start to come down. Have a very, very good week. Please don't hesitate to get in touch. I'm here. I will call you back. I'll email you. We will get to the bottom of any question that you have. Take very, very good care. We'll be back next week. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.